Our big story tonight for November. SIPs continue to come in strong and they've come in above 13,000 crore rupees. It's happened for the second month in a row. And now they've hit those record high levels for the month of November. You're seeing, on the other hand, equity inflows dipping to their lowest since April 2021. Of course, the silver lining is the fact that the segment has been seeing inflows for the last 21 months. The equity assets under management, the AUM, is at an all-time high. It's crossed 15 lakh crore rupees. And the total assets under management too are at their all-time high levels. So we had a word with the CEO of the Association of Mutual Funds of India, NS Venkatesh, and he's broken down for us what really is the story behind the numbers. Here's an excerpt of that chat.
Equity flows have fallen down. Equity flows have fallen down for the simple reason that the markets are at an all-time high. So people are booking their profits and maybe using it for their consumption purposes because it's all festival season at this particular point of time. So I think they are using that. So I believe that going ahead with the budget just around the corner, with a good budget, we should see more cheer coming back into the market. And with that, you will see more flows coming back into the mutual fund equity segment as well.
And sir, if we talk about the debt mutual fund, so what kind of signals you are getting from that? Because we have seen that interest rate scenario is changing again.
What we are seeing is essentially people are withdrawing money from the interest rate sensitive segment of the debt segment. Money is there in the liquid funds and maybe partially in the overnight funds where the interest rate sensitivity is practically nil, whereas in the short duration fund, medium duration fund, long duration fund, corporate bond and PSU bond funds, you are actually seeing money outflows happening because there essentially the interest rate sensitivity is there.
Let's get perspective on what we're hearing from the AMFI CEO, and for that, two experts joining us on India Tonight. Mahantesh Sabarad is an independent market expert, and Amol Joshi is the founder of PlanRupee Investment Services. Gentlemen, thanks for making the time and joining us on the show tonight. Amol Joshi, coming to you first. I'm looking at the latest AMFI data. I'm sure you have too. Would you say the Indian investor is seeing the rising interest rate scenario, like Mr. Venkatesh is pointing out, and then taking the right calls for their portfolio, looking at the way interest rates are moving?
Well, Vikram, you are right. AMFI CEO is on dot when he says that interest rates are going up. Now, the primary impact of interest rates going up, you will immediately see on the debt funds, especially on the longer end of the duration segment, especially the medium duration and long duration funds. As we know very briefly, as the interest rates go up, the fund will show or the bond will show mark-to-market capital drawdowns or capital losses. So that's the reason when investors see actually the NAV is taking kind of a hit or NAV is not moving for weeks or months together, that's the time when investors will rethink. So that's one side of the coin. And on the second side, you also have banks slowly started raising rates. So you have seen bank rates on 1 year FD is going all the way from lows of 4.75, 4.9, all the way to 550 or in some cases 6% plus also. So it's kind of a double whammy in a rising interest rate scenario. Rising interest rate scenario will also kind of impact equity, but that impact will be as the corporate earnings actually take hit when the interest rate burden goes up. So it's a two-pronged impact, which we are seeing, especially on the debt side at the first go.
How are you reading the kind of numbers that AMFI has put out, looking at the possible correlation between how investors are parking their money in equities at the current juncture? Where exactly do you see that actually showing up the most? The way the markets are moving, the corporate earnings, like Amol is pointing out as well, where is the correlation according to you?
See, the correlation of the funds is clearly got to do with the fact that equities are looking quite better right now related to the debt mutual funds. As you are aware, interest rates rise, the debt value goes down. So equity deployment is something that is what we are clearly seeing. But then new fund inflow, even though the new inflow is slackening, there is still a growth that we are seeing in the overall AUM size of the market. I don't really foresee that we will see a negative, basically an outflow in the funds, corpus gathering or corpus taking in kind of activity.
Well, some of these biggest equity categories that we look at, whether it's large cap funds, focused ELSS funds, flexi cap funds, all of them have seen these net outflows. When you look at the month of November, with large cap funds, they've led the outflow table. What do you put that down to?
Right, Vikram. So the equity outflow, again, taking a leaf out of MCCO's book, what he said, one is definitely there is a profit booking, but other than the festival season and profit booking, there is another angle too when we actually have client conversations. And that conversation is largely to do with the impact or the globalization. So you see now, even the markets, because of the technology as well as other explosions compared to the information explosion, what investors are currently very much worried about is the kind of recession talk that is going on across the world. So that's also another factor that is playing on the minds of investors. And see, let's also remember something very, very clearly. We saw a big drawdown of about 35% in the early part, first quarter of calendar 2020. And after that, market has rallied significantly. Market has rallied more than 100% from those lows. So investors who stayed put via SIPs or were able to put in money when chips were really down, they have made significant, much higher double-digit returns in large cap segments. And some of the mid and small cap funds have a CAGR of in excess of 30%. So when that kind of lucrative gains are on the table, and you hear all the talks about the impending recession being around the corner, that's when you like to take some money off the table. And this is where rising interest rates have also played some factor that people do feel that I also have an opportunity to maybe take 10%, 20% profits out of the mutual fund and deploy it at a slightly higher interest rates in a traditional fixed income investments as well as within the debt segment. At the same time, it is heartening to see that mutual fund SIP inflows have continuously remained above the 13,000 crore, and in all likelihood, this year we will see a 20% kind of growth. Last financial year number, if you remember, it was total SIP financial year collection was to the tune of 1,24,000 crore, and in all likelihood, for all these months of this financial year, we are keeping very above the 12,000 crore marks. So we are likely to close at 1.44 or to 1.50 lakh crores, which is a robust 20% growth. So I would say systematic investments has really caught on, but people do not shy away from taking money off the table whenever they see a need to be fulfilled in their financial goals or wherever they see some risks on the horizon.
Yes, indeed. So investors are getting that much smarter and that much wiser, looking at the SIP route, and that has been seeing consistent growth. Mahantesh, when you look at the debt side of investments right now, at least in the month of November, we're looking at liquid funds and corporate bond funds, the money market funds. They've seen big inflows. Do you see that continue over a period of time? At this juncture, when you're looking at a higher interest rate scenario, is this flavor of the season going to remain that?
See, firstly, we should understand that most of these debt funds on the, and particularly on the money market funds, are not really retail funds. These are institutional funds, right? So there is a arbitrage opportunity that institutionals find when they have to deploy excess liquidity that they hold. That excess liquidity obviously gets driven into mutual funds, and some of that gets absorbed by the large mutual funds. So from a purely perspective of whether that inflow will continue to be there is a function of how RBI interest rates will now will take course. We are already closer to the peak of RBI's rate hike cycle, and it tells me that so long as that peak is not hit, you will continue to see probably some inflows coming to these debt mutual funds. Retail has a really very minimal role on the debt side when it comes to the mutual fund place.
Amol, when you look at these index funds, historically they've done well. Do you see them continue on their good run?
Vikram, as we know, index funds will deliver very, very close to what the underlying is doing. In the sense, if you're talking about a large cap index fund, we are really talking about how Nifty or Nifty Next 50 will do. So you're actually asking me to, you're actually asking what is my call on the index going ahead. See, on some parameters like price to book, you would see kind of elevated readings. However, if you look at other metrics like market cap to GDP, however, you look at other factors of valuations, including what I mentioned, market cap to GDP or earning per share, compared to all those estimates, as well as you see the current market return is when FIIs have really pulled the money out of the Indian markets. The flows have started back, but compared to what they have pulled out, it's a trickle. When all of these things actually as a confluence, when they turn positive, I would say over a 3 to 5 year, I continue to believe that index or equities in general offer you the kind of double-digit returns that you expect them to deliver to make up for the by giving you risk premium over the debt returns. And debt returns themselves have got robust about here. So short-term volatility is not ruled out, but I would say that equities continue to be continue to claim their rightful space in the in the medium to long-term investments of our investors, and that's how we are designing our portfolios currently.
I wonder if you agree, because typically equities have been thought of as a place for those who don't mind taking risks. So when you see more investors seeking exposure to equities right now, is it about less risk aversion among investors, or is it that our equity universe has become less risky over the years?
Yeah, I think the latter is true. Our equity investments in the markets have become less risky. And I say that because we as a country have a very diversified equity market. Although we have banks forming the major chunk of the market capitalization, but by virtue of banks lending to all the sectors in the economy, we have a well-diversified equity market. The diversification is not just by sectors, the diversification is also geography-wise. We are a very large country from a geographical spread point of view, and that diversification exists pretty much there. We also have diversification in the form of market capitalization, the sizes of the companies that we have. We have diversification in the form of private companies, MNC companies, government companies, etc. So purely from that point of view, I tend to believe that it's become a little less riskier relative to the other markets. Although I don't want to wish away the risk that exists in equity market, they do exist. Having said that, the primary reason why markets keep continuing to go up is that the corporate earnings are robust. Whenever you have a large economy like ours growing fast, corporate earnings also take center stage. They grow fast, furthermore faster, and that means we will have better returns from stock markets.
That's always the hope and the desire. Looking at the kind of data that we are indeed quite hopeful of that taking place. But thanks very much for your perspective and for really underlining what is really out there in these numbers right now. Amol and Mahantesh, pleasure chatting with you on India Tonight.